On January 16, 2026, the Chinese yuan crossed a threshold that should have triggered alarm across global financial markets. It reached 6.9644 per US dollar, the strongest level in 32 months, while simultaneously the People's Bank of China announced a 25 basis point cut to its one-year relending rate, effective January 20th. This combination, currency appreciation paired with monetary easing, is not what disciplined central banks typically do. When a currency strengthens, a rational authority would raise rates to cool demand and prevent overheating. Instead, the opposite occurred. The headlines read as if this were normal. Financial media reported the yuan's strength as evidence of confidence in China's economy and global de-dollarization momentum. Yet, beneath the surface, this event carries the precise mechanics that have preceded multiple major financial crises over the past century. The public narrative and the consensus of professional investors remains anchored to an assumption that this is managed, controllable, and ultimately benign. That assumption is where the danger lives. The visible story is straightforward on the surface. December 2025 brought China a record trade surplus. Chinese banks processed record volumes of foreign currency conversions into yuan as corporate clients and capital exporters rushed to convert dollars at strengthening rates. Investment banks revised their yuan forecasts higher. Morgan Stanley predicted 6.85 per dollar. Australia and New Zealand Banking Group forecast the same level by year-end. Macquarie Group predicted 6.8. The yuan's daily strengthening has been gradual, managed, deliberate. The PBOC's rate cut announcement framed as additional stimulus to support growth. Global funds increased their China positions based on this signal. The narrative crystallized. China was opening again, its currency was internationalizing, de-dollarization was accelerating, and the PBOC had everything under control. This is the story that required no alarm. This is the story that felt inevitable and appropriate given the direction of history. But consider a single fact in isolation. Over the past 12 months, the yuan appreciated 5.1%. This is not a small movement in currency markets. It is a structural revaluation. Every Chinese exporter holding unhedged dollar receivables, which represents the majority of the population of unhedged positions, experienced an effective 5% pay cut on every dollar of overseas revenue converted back into yuan. When a firm's entire margin exists in the 2 to 4% range, a 5% currency headwind does not compress margins. It eliminates them. Worse, most of these exporters had hedged expecting depreciation or stability. The cost of hedging 12 months ago was around 4% for full-year forwards. Today, hedging costs have collapsed to 1.7%, a 3-year low. This tells us something critical. The market has already priced in that currency appreciation is permanent, perhaps even accelerating. New hedges are cheap because the market believes there is little downside protection value in purchasing them. This is the behavior of a market convinced a trend will persist. Yet the same market that is pricing permanence in yuan appreciation has also absorbed a simultaneous 25 basis point rate cut from the PBOC. In the normal course of monetary policy, this is incoherent. A central bank does not cut rates to support its currency while that currency is appreciating. It cuts rates when it wants to depreciate the currency to support exports or when the economy is weakening. The PBOC did neither. Instead, it cut rates while tolerating, even facilitating, yuan strength. This is the signal of an institution managing multiple incompatible objectives. It wants to support domestic asset prices and growth to prevent a property sector collapse. It also wants a strong currency to facilitate capital exports and de-dollarization objectives. These cannot both be achieved without cost. The rate cut signals that the priority is now domestic financial stability, not export competitiveness. This represents a structural shift in policy trade-offs. The mechanism of this trade-off is worth understanding precisely. When a central bank cuts rates while its currency appreciates, it sends a message that export margin compression is acceptable collateral damage. Chinese exporters will experience unambiguous margin pressure across the first quarter of 2026 and beyond. A typical Chinese exporter in electronics, textiles, machinery, or automotive components operates with 4 to 6% net margins before taxes. A 5% currency appreciation against the dollar compounds with typical 1 to 3% volume pressure in a slower global trade environment to create a 13 to 14% net margin compression scenario. Most firms cannot absorb this without cutting wages, deferring capital expenditure, or reducing employment. History shows this is exactly the path that follows managed currency appreciation, accompanied by monetary easing. Japan experienced precisely this sequence in 1985. The Plaza Accord was signed in September of that year. The G5 nations formally agreed to appreciate the yen against the dollar. The yen strengthened from 240 per dollar to 145 per dollar within 2 years. This was not a gradual shift. It was rapid and deliberate. The Bank of Japan simultaneously cut rates from above 8% in late 1985 to just above 3% by early 1987. The official rationale was to offset the Indaka Fukyo, the recession induced by strong yen pressure on exporters. But this monetary easing did not prevent exporter distress. What it did instead was redirect capital away from productive investment in tradable sectors and into domestic asset markets. Japanese real estate prices and equity valuations entered a speculative bubble. The Nikkei index climbed from 9,000 in 1985 to nearly 40,000 by 1989. Real estate in central Tokyo achieved prices that even today look delirious when examined from a cash flow perspective. The Bank of Japan maintained this easy monetary stance, believing it could indefinitely substitute asset price inflation for export growth. What followed was the lost decade. The Japanese economy entered deflationary stagnation in the 1990s that persisted for 2 decades. The currency appreciation was the trigger. The rate cuts were the amplifier. There's a second historical parallel that mirrors the current situation more closely. China itself undertook a major currency unification on January 1st, 1994. Prior to that date, China operated a dual exchange rate system. The official rate and the market rate diverged significantly. The official rate was fixed at 5.8 yuan per dollar, while the market rate traded much weaker at higher yuan values per dollar. On January 1st, 1994, the government unified these rates at 8.7 yuan per dollar. This was nominally a massive devaluation. But the devaluation was only against an artificially strong official peg. Against the true market rate, the unification was actually a substantial appreciation. More importantly, once unified, the rate began an inexorable appreciation as foreign currency inflows mounted and foreign direct investment surged into China. The PBOC accumulated foreign reserves through continued market pressure for yuan strength. The unified rate tightened from 8.7 in 1994 to 8.28 by 1997 and was held at that level through the Asian financial crisis and beyond. What happened to China during this period of managed depreciation? Export margin pressure mounted. Regional competitors in Korea, Taiwan, and other Southeast Asian nations devalued sharply during the 1997 Asian crisis, gaining competitive advantage against the appreciating yuan. Chinese exporters faced pressure that ultimately contributed to the Asian contagion, spreading beyond initial epicenters. The appreciation was initially justified as stabilizing the currency and signaling reformist credentials to the world. What it actually did was transfer purchasing power from export workers and tradable sector entrepreneurs to the owners of assets denominated in foreign currency and to capital exporters. The case of Britain and the pound in 1925 adds even sharper clarity. In April of that year, Chancellor of the Exchequer Winston Churchill announced Britain's return to the gold standard. The pound was pegged at $4.86, its pre-war parity. This rate was widely understood by contemporary economists to be overvalued by approximately 10%. John Maynard Keynes published vehement warnings that the revaluation would trigger deflationary pressure and unemployment. Churchill proceeded anyway, justifying the move as a restoration of sound money and credibility. What followed was predictable. British exports became 10% more expensive overnight. Coal, textiles, and manufactured goods faced immediate demand destruction. The coal industry was devastated. The 1926 general strike occurred directly in response to wage cuts miners were forced to absorb. Britain entered deflationary stagnation that persisted until the pound was devalued in 1931, 7 years later. Yet, at the time of Churchill's announcement, the financial establishment praised the move. The pound, once again on gold, would restore international confidence. This is exactly the narrative that dominates today. The yuan, once more in evidence of strength and international acceptance, will accelerate de-dollarization and Chinese ascendancy. The parallel holds. A currency revaluation framed as credibility and stability can be the trigger for sustained economic distress. When Russia defended its currency peg in 1998, the mechanism differed in detail but tracked the same path. The central bank raised its refinance rate to 50% by May 1998. This was an attempt to attract foreign capital inflows and support the ruble's exchange rate band. It did not work. Instead, the government accumulated short-term domestic debt, issuing GKOs and OFZ securities at the elevated yields. Foreign investors, drawn by the 50% return, rolled over maturing debt repeatedly. But the underlying fiscal position was unsustainable. Oil prices had collapsed. The government could not achieve the tax revenue assumed in its fiscal projections. On August 17, 1998, the central bank announced a band widening for the ruble. Within days, the currency had collapsed 75%. The default was announced. A moratorium on payments to foreign creditors was declared. The contagion spread across emerging markets globally within weeks. Russia's wage earners, depositors, and pensioners experienced the destruction of their purchasing power. Foreign investors who exited early escaped losses. Those who remained were devastated. The interesting parallel to China is not the specific mechanics, rather it is the intermediate phase. In that phase, the central bank's signals of control were technically accurate but fundamentally misleading. The 50% rate was genuinely being offered. The peg was being genuinely defended, for a time. But the defense was unsustainable, given the underlying imbalances. When the sustainability finally ran out, the reversal was discontinuous and devastating. Mexico's 1994 situation paralleled this as well. The peso had been defended at a fixed peg since 1988. The rate had been stable for 6 years. The stability created the illusion that the peg was permanent. Meanwhile, Mexico's current account deficit had widened to 7% of GDP. Foreign currency reserves were being depleted to defend the peg in the face of consistent capital outflows. The government had shifted the composition of its short-term debt from peso-denominated CDs toward dollar-guaranteed instruments called tesobonos, allowing it to borrow at lower rates. But this exposed the central bank to the requirement to convert pesos to dollars at precisely the moment when confidence was collapsing. Political shocks in 1994 amplified the stress. The assassination of the ruling party's presidential candidate in March created a crisis of confidence. On December 20th, 1994, the incoming administration devalued the peso by 13 to 15%. Markets interpreted this not as a one-time adjustment, but as a signal that further devaluation was coming. Capital flight accelerated. Within days, the peso had collapsed to 5.15 per dollar, a 50% loss from its peg level of 3.5. Unemployment spiked, GDP contracted 6%, inflation exceeded 50%. The cost in human welfare was immense. Yet, in the years before December 20th, the consensus viewed the peg as credible and the economy as fundamentally sound. These historical cases are not offered as predictions. Rather, they are examples of a recursive structural pattern. A currency is managed higher, either through direct policy action or through accumulated imbalances that create unavoidable pressure. A central bank cuts rates to manage the economic consequences of that appreciation. The rate cut creates asset price inflation and masks the underlying deterioration in tradable sector competitiveness. Foreign investors, observing the rate cuts and the currency strength, interpret both as signals of policy control and confidence. They hold, or even increase, their exposure. Meanwhile, unhedged exporters and domestic firms with dollar liabilities experience deteriorating cash flow. Their balance sheets weaken. But this deterioration is not yet visible in financial statements, which are reported with a 2 to 3 month lag. By the time it becomes visible, the momentum of capital flows has created a crowded trade. When the first major defector exits, others follow. The herding dynamic that was previously directed toward accumulation reverses toward liquidation. In the worst cases, this reversal is sudden and severe. The wealth transfer that occurs through this sequence is worth examining precisely. In China's current situation, the primary losers are Chinese exporters holding unhedged dollar receivables. A 10% currency appreciation reduces the capital expenditure to assets ratio by 30 to 60 basis points for firms carrying dollar-denominated debt. This translates directly to reduced investment, lower employment, and lower wages in export-dependent regions. The hedging cost collapse to 1.7% suggests that margin compression is expected to persist. New exporters attempting to hedge now will lock in the 6.96 level, accepting the 5% loss that has already occurred. Emerging market currency holders and savers lose as well. The yuan's strength creates capital reallocation away from higher-yielding emerging market currencies like the Indian rupee, Indonesian rupiah, and Philippine peso. As capital flows out of these currencies, they depreciate. Savers and pensioners in these countries experience purchasing power destruction. Their currencies weaken against both the dollar and the yuan. Commodity exporting economies see double losses. Lower commodity prices paired with weaker currencies reduce both their export revenues in nominal terms and their ability to convert those revenues at favorable exchange rates. Asian export competitors outside China experience similar margin pressure. Korean semiconductor manufacturers, Taiwanese chip makers, and Vietnamese textile exporters lose competitiveness as their currencies do not appreciate in tandem with the yuan. Chinese high-tech exports become more price competitive globally, displacing them in markets where they previously held position. The Korean won pressure illustrates this. USD to KRW strengthened back to 1,470 from 1,430. This is not accidental. It reflects capital allocation responding to perceived relative strength in China versus Korea. Who gains from this reallocation? Chinese domestic asset holders gain substantially. The $1.2 trillion 2025 trade surplus created a windfall of capital exports. Only 13% of that windfall flowed to PBOC foreign reserves. 87% went to private companies, individuals, and state-owned enterprises. Yuan appreciation increases the purchasing power of these exports. 1 yuan converts to 14.4 cents today versus 13.7 cents a year ago. This 3% improvement in purchasing power applies to that $800 billion capital export flows. That is $24 billion in additional purchasing power for overseas acquisitions, real estate, and machinery purchases. This wealth transfer from exporters' lost margins flows directly to capital exporters' purchasing power gains. RMB-denominated asset holders capture capital appreciation as the yuan strengthens. Global investors and institutions have been overweighting RMB assets. Goldman Sachs, Bernstein, and Bank of America have all recommended overweight China on the theory that de-dollarization would accelerate yuan strength. Those positions capture paper gains as the currency appreciates. De-dollarization infrastructure accelerates. 27% of China's trade, or $17 trillion annually, already settles in local currencies. The PBOC's cross-border interbank payment system expands yuan adoption across BRICS nations and global south counterparties. Chinese banks shift new cross-border lending from dollars to RMB. This creates structural demand for RMB liquidity and supports sustained appreciation. The Federal Reserve and U.S. inflation-fighting authorities benefit indirectly. Yuan's strength reduces U.S. import prices on Chinese goods, which comprise 20% of U.S. imports by value. This creates a deflationary impulse to U.S. consumer price inflation. It supports the Fed's price stability mandate. Chinese goods becoming more expensive in local currency terms dampens import demand globally, which indirectly eases political pressure on the Fed from trade war rhetoric and sectoral lobbying. Commodity-producing nations receiving yuan as trade currency theoretically gain. Russia, Iran, Venezuela, and African nations whose export revenues come in yuan now hold currency with greater purchasing power when converted for Chinese goods purchases. But Trump has announced a 25% tariff on countries doing business with Iran, and similar secondary sanctions may cascade through the dollar-denied trade arrangements that have been developing. The gain may prove illusory. The second-order effects develop in phases. In the immediate term, January through March 2026, Chinese exporter margin compression cascades into wage cuts, deferred capital expenditure, and reduced hiring. This replicates the pattern seen in Japan after the Plaza Accord. Carry trade unwinding accelerates. Yen-funded trades, which have been profitable when yen was cheap and Chinese assets were rising, become less attractive as the yen-CNY yield differential narrows. Forced selling of emerging market equities and bonds accelerates. Asian currencies weaken as hot money exits. Korean won, Indonesian rupiah, and Philippine peso all move weaker. This weakness passes through into domestic inflation via rising import costs. Asian central banks face pressure to consider rate hikes despite weak growth, creating the policy dilemma where they must choose between defending currencies and supporting domestic demand. In the March through June phase, deflationary pressures intensify in China itself. If PBOC continues rate cuts while the yuan appreciates, this creates the precise dynamic that preceded Japan's lost decade. Chinese bank net interest margins, already compressed by the recent 12 trillion yuan debt swap program, tighten further. Emerging market bond yields widen as foreign investors liquidate holdings. India, Indonesia, and the Philippines see credit spreads spike relative to U.S. treasuries. Regional central banks face a classic impossible dilemma. Defending currencies requires rate hikes, which throttles growth, allowing currency depreciation imports inflation. Both paths destroy balance sheets. This is the policy trap that preceded Mexico's 1994 crisis. In the June through December phase, if Chinese exporters have not hedged by the second quarter and global trade shows continued weakness, capital flight risks amplify. This replicates the uncontrolled capital outflows seen in Russia 1998 and China's own 1997 through 1998 crisis period. Real estate sector stress in China deepens as yuan appreciation compresses margins on construction material inputs. Cement, steel, and machinery input costs denominated in foreign currency become prohibitively expensive. Singapore and Hong Kong banking sectors face contagion risk from emerging market bond volatility and capital reallocation away from regional financial hubs. These wealth transfers occur at different speeds and with different visibility. Currency spot rate movements are instantaneous, visible within seconds to anyone monitoring exchange rates. But the underlying wealth transfer unfolds much more slowly. Corporate earnings impacts emerge only over quarterly earnings cycles. Q1 2026 earnings reports in April and May will show the first objective signal of margin compression from the January yuan appreciation. Prior to then, market participants rely on narrative, analyst consensus, and central bank signaling. All of these sources are incentivized to minimize crisis narratives and to emphasize continuity. Herding accelerates the outcome. As long as the consensus interprets yuan strength as positive for China and good for de-dollarization, contrarians questioning the narrative face dismissal and career risk. Portfolio rebalancing can reverse suddenly, but only when forced by margin calls, reserve depletion, or explicit policy surprises. The visibility of this phenomenon is fundamentally asymmetric. It is visible to corporate treasurers managing forex hedges, to emerging market central bankers watching reserve depletion, and to derivatives traders monitoring options pricing. It is invisible to retail investors holding emerging market equity funds, to pension fund managers who rely on external emerging market allocators, and to most financial media commentators focused on earnings growth rather than currency dynamics. The mechanism of invisibility operates through accounting lags and derivative opacity. Margin compression appears on balance sheets only when quarterly earnings are reported. Currency derivative losses are buried in other income line items. Emerging market capital outflows manifest first in broad equity indices declining, with individual currency pressure becoming visible later to professional traders only. Why is it that professional investors, despite having superior information tools and economic training, systematically underestimate these risks until crisis becomes inevitable? The answer lies not in information gaps, but in structural incentive distortions and cognitive biases that operate across entire populations of decision makers simultaneously. The first of these is normalcy bias. Investors, policymakers, and the public systematically underestimate the probability of nonlinear, discontinuous events. The yuan has been stable or appreciating for 2 years. It has been stable for even longer in absolute terms. Investors perceive the current pace of appreciation as manageable because nothing catastrophic has happened yet. The 6-year stability of the Mexican peso before the December 1994 devaluation created exactly this perception. Investors assumed the peg was immutable. Russia's exchange rate band had been held for 3 years before its collapse in August 1998. But recent experience anchors expectations more powerfully than historical precedent. The recency of the stable period creates underestimation of discontinuity risk. The second is authority bias. Market participants grant excessive credibility to central bank policy signals and forward guidance, particularly when senior officials project confidence and competence. The PBOC's announcement of rate cuts is interpreted as evidence of policy control, but central bank communication inherently contains information asymmetry. The PBOC may know of stress conditions that are not yet visible to markets, capital flows, bank liquidity pressures, or emerging defaults in the property sector. But markets interpret silence on these topics as confirmation that no problems exist. The central bank's technical credibility in managing the currency band is interpreted as strategic credibility in managing the entire system. Before Russia's August 1998 default, the central bank had technically kept the ruble within its band. This was, technically, credible policy execution, but it masked unsustainable debt accumulation and currency mismatch. The technical success became evidence of strategic success until it suddenly was not. The third is herding behavior and consensus bias. During normal times, investors rationally follow consensus because their compensation depends on relative performance versus benchmarks. Fund managers whose allocations deviate from the consensus underperform relative peers, losing clients and compensation even when their contrarian views eventually prove correct. A fund manager who reduced China exposure in late 2024 on early warning signals would underperform the 2025 China rally and would likely be fired before vindication arrived in 2026. This creates a rational incentive to herd, to ignore tail risks, and to extrapolate recent trends regardless of underlying fundamentals. In Russia 1998, herding manifested as GKO buyers imitating each other without independent assessment of default risk. Foreign investors who exited early were initially seen as overreacting. Once the first wave of selling started, herding accelerated the contagion across emerging markets within weeks. The fourth is overconfidence in quantitative models and extrapolation bias. Traders and analysts systematically extrapolate recent trends into the future. Yuan strengthening, falling hedging costs, rising carry trade returns are all extended forward in models, without recalibration of tail risk. Analyst earnings forecasts for Chinese exporters embed assumptions of stable or appreciating yuan. When the yuan accelerates beyond model assumptions, analysts are slow to revise downward. Professional investors also overestimate their ability to predict central bank reversals or capital flow shifts. The illusion of precision in value at risk models obscures tail event vulnerability. The fifth is recency bias and narrative dominance. Investors overweight recent market performance and underweight historical analogs. Because the past 2 years have seen gradual yuan appreciation without acute crisis, The current pace is perceived as manageable rather than as a replay of the Plaza Accord in 1985 or China's own 1994 unification. Media narratives emphasizing China's strength and yuan internationalization dominate risk narratives. Historical crashes feel temporally distant and empirically inapplicable. The vivid memory of central bank wins in prior crises overshadows the less visible losses in corporate balance sheets and exporter competitiveness. These biases are not personal failings. They are structural features of how capital markets operate. Professional incentive structures create rational herding. Career horizons in finance are 3 to 5 years. A manager who exits positions during the slow accumulation phase sacrifices 2 to 3 years of returns before vindication. By the time vindication arrives, that manager has moved to a different firm or retired. The manager who stays overweight throughout the accumulation phase collects bonuses for outperformance until the acute crisis hits. By then, they may have already exited, leaving successors to manage the losses. Central bankers face similar structures. Declaring an impending crisis destroys their authority before the crisis materializes. Markets punish early warnings with volatility and capital flight. So officials have incentive to maintain confidence narratives until forced revaluation becomes inescapable. The information lag between exporter margin compression and its appearance in quarterly earnings is typically 3 to 4 months. By the time objective signals appear, crowded trades have formed. The first major defector creates cascade selling. Moral hazard amplifies these dynamics. Investors assume that policy interventions will prevent acute crisis because central banks have backstopped markets in prior episodes. This assumption was violated in Russia 1998, when the IMF rescue did not materialize. But each new rescue increases the assumption that the next crisis will also be managed. The PBOC's recent aggressive interventions signal willingness to support the financial system. This inadvertently increases investor confidence that acute crises will be prevented, leading to higher leverage and greater imbalance accumulation. If this pattern continues, the systemic implications are substantial. Chinese exporters will experience unambiguous margin pressure in Q1 2026 earnings and potentially beyond. Companies with minimal hedges will report significant losses. Some will cut capital expenditure sharply. Employment will decline in manufacturing-dependent regions. This creates domestic political pressure on the PBOC to reverse course, cutting rates and weakening the currency. But by the time this reversal becomes obvious, capital flows will have begun to anticipate it. The reversal signal itself will accelerate capital flight, not stem it. Emerging market authorities will face the impossible choice between defending currencies and supporting growth. The carry trade unwinding will accelerate as the yen-CNY differential narrows. Forced selling of emerging market assets will mount. Regional bond spreads will widen. Asian equity indices will decline. The contagion will begin to appear in financial headlines as something separate from the yuan story, when in fact it is a direct consequence of the same capital flow reversal. If the capital flight accelerates enough to create visible reserve depletion in emerging markets or visible stress in emerging market banking systems, the contagion will cross over into developed market perceptions. Volatility indices will spike. Risk-off sentiment will dominate. Leverage and sophisticated trading strategies will be unwound across global markets. This is the mechanism by which a Chinese currency event becomes a global financial event. The outcome is not predetermined. Central banks retain genuine policy tools. The PBOC could reverse course on the rate cuts, raising rates and signaling currency stability. This would stabilize capital flows and prevent acute crisis, but it would require accepting domestic financial stress and property sector pressure. Other central banks could coordinate currency intervention to smooth the depreciation of emerging market currencies, but this requires cooperation that is difficult to achieve and sustain. Markets could gradually reprice assets to reflect the new risks, but this requires that marginal decision makers move from complacency to caution before their positions are forced closed. What is not in doubt is the structural vulnerability. Chinese exporters are exposed to unhedged currency positions that create margin pressure in a stronger yuan environment. Emerging markets are dependent on capital inflows that create vulnerability to sudden reversals. The speed of capital flight, once it begins, cannot be controlled precisely. History provides a menu of examples. The specific outcomes vary. The mechanical pattern is consistent. When managed currency appreciation is paired with rate cuts to manage the domestic consequences, the resulting set of incentives eventually creates capital flight. The timing is unpredictable. The direction is not. The January 2026 yuan appreciation and PBOC rate cut represent the triggering mechanism of a known pattern. Professional investors are not positioned for this outcome because career incentives, herding dynamics, and cognitive biases all align to create complacency. The consensus narrative emphasizes continuity and stability. The market structure favors remaining in the consensus until forced to move. Information lags ensure that the first objective signals of deterioration will not appear until March or April at the earliest. By then, if the pattern holds, the momentum toward capital reallocation will be difficult to reverse. None of this is certain, but none of it is speculative either. This is the structure of how capital markets have operated repeatedly across different countries, different eras, and different institutional arrangements. The current situation in China and emerging markets fits the template precisely.